I'm Charlotte McLeod with investingnews.com, and here today with me is Nick Frappell, Global Head of Institutional Markets at ABC Refinery. Thank you so much for being here. Great to have you.
Charlotte.
Really good to be speaking with you, and we're going to go into the gold market today. Where I thought we could start, we're going to look at some of the main drivers that you see coming in 2024, and I thought we could start with the Fed because a lot of people are watching very closely. It seems like at this point, people have adjusted their expectations for what we're going to see in terms of rate cuts this year. So I wanted to hear from you on what you see coming, how you're looking at that.
Yeah, look, basically, it always seems that the market is, being quite if you like, opposed to the Fed, or maybe misreading the seriousness of the Fed's intention to drive inflation lower. And so this sort of like argument about higher for longer has really proceeded for the last year or so. I think 2024, as things stand at the moment, and given where the Fed's preferred inflation measure, PCE, is coming in, and the sort of dialogue from the Fed speak, if you want to call it that, I think that we should expect somewhat higher for longer. And that sort of dialogue actually isn't unique to the Fed. It's coming out of a couple of the other central banks as well. So I expect higher rates to persist. And as you said, the market's changed quite rapidly in terms of what it thought, say, in December, in January, and early Feb. So the idea of a March cut pretty much out of the question in terms of what futures are pricing. I think in May, the thought of a 25 basis point cut has come from being about a 60-odd% probability, 65% probability. It's come down to about 22% probability. And then if you look through to January of next year and just see where the market might land there, the Fed funds is, I think it's like roughly 50 or so basis points higher than where people thought it was. It's still declining, it's still going down, but that point of decline, I think it was priced in at about 3.7 is the general market consensus, and it's now about 4.2, I think, from memory. So that's a really big change, like 0.5% difference in people's estimation of where the Fed funds will land in 10 or 11 months' time.
Well, in talking about these changing expectations, I think people have watched the Fed do this balancing act where it tries to tame inflation without harming the economy too much. And it seems like so far it's done a better job than people were expecting. So do you think we'll achieve that soft landing that the Fed is trying to get?
They seem to have done a pretty good job. So I'm inclined to say yes. There are some data points that have come out that have been a little bit weak, and the end of last week, I think US PMI was a little bit of a miss. UMich consumer sentiment was a bit of a miss. Those are the two that come to mind. But of all the data points and the sequences of the time series the Fed would look at, those are two so far. And going back to last week's PCE inflation, they came sort of pretty much bang on. So one thing which we might touch upon, I guess, is that there's so many events that are completely outside the Fed's control and completely outside our control. Those things could intervene and provide shocks to the economy that, we can't know. I think if you look in 2024, does look like so far so good, which is not at all what, a lot of people are pretty pessimistic about that. I'm neutral to mildly optimistic.
Right. And continuing on in terms of gold price drivers, another one is the dollar. So I thought maybe we could take a quick look at dollar expectations for this coming year.
Sure. Looking at the dollar in terms of just like broad trade-weighted dollar at DXY, I'm moderately positive about the dollar, which obviously implies a headwind for gold. But there are other tailwinds as well. I think that's for a couple of reasons. Partly because I think U.S. growth will continue to be fairly good. I'm relatively positive about U.S. growth through through 24. And I expect that will attract people into U.S. assets, and it'll be good for the dollar. On a slightly sort of technical lens, I think that the dollar cycle, about the roughly 39-month cycle, I think that might have bottomed out earlier this year, maybe 6 to 8 weeks ago, and that would provide a bit of a tailwind for the dollar as well. Painting with a really broad brush, but it has held reasonably well for the last sort of several cycles, and that's a sort of a slight positive. Now, many very credible observers have looked at the dollar, and they've estimated, for example, Vanguard estimate the dollar is about 10-12% overvalued compared to its peers. or compared to a basket of 5. And I think that could be absolutely right. I'm not going to argue with that at all. But what I would say is that currencies can be overvalued or undervalued quite significantly and carry on that way for a long time. And you just have to look at the Japanese yen. I think the consensus is the yen is incredibly undervalued, but it's been on a tear. Well, it's down on the downside. It's been on a real weakening trend since, March 21, so for the last 3 years. And people, including me, talk about hoping and expecting for a yen rally at some point in this year. But I think it's fair to say, apart from a few short-term things, we've all been brutally disappointed. So I think that whilst the dollar there might be a good economic case to say, yeah, overvalued, that doesn't mean it's going to turn tomorrow. So 24 expects strength, not huge strength, but in dollar index terms, say 109, 108, 109, possibly pushing on to 114. Not making any really big predictions there, but that's where I see it.
So possibly a little bit of a headwind there for gold. But also, on the other hand, we've seen central banks providing such strong support for gold over the last couple of years with the extensive buying. So I thought we could talk a little bit about that in 2024 as well. Of course, there is a divide between which central banks are actually buying and which ones are not. So your thoughts on 2024?
Well, take it in aggregate. I think 24 will see a continuation of central bank demand. We've had 2 years of really good demand. I think that it's gold's such a good liquid portfolio diversification thing, not just for individuals, but also for central banks. And if you look at, I guess, the drivers, there are very few central banks that I think would be considered overweight in gold. I think plenty would look at it as rather than accumulating foreign exchange reserves in other people's bonds, which they might say, look, depending on how the outlook goes, might prove to either be too volatile or it might prove, they've got enough of them. So that onward drive to diversify into gold or carry on buying gold, I think it's still there. And I would not be surprised to see a repeat of the last 2 years, numbers in tonnage terms.
Okay, so those are a few of the main. Yes, that's a positive one. Yes. Good to sum it up. And so those are a few of the main price drivers that people tend to think of when it comes to gold. But are there any others that you are watching right now?
The big one I would always watch, and it's not always, it's pretty reliable, pretty robust, and that is looking at real interest rates. And generally the way that we sort of find a proxy for that, because true real interest rates or neutral rate of interest might not be, they basically, confusing two concepts there, but usually I look at it via the US Treasury and inflation-protected bond yield. Nothing's perfect, but that's not a bad guide, and it's got a fairly good kind of like explanatory factor for the price, for the gold price. Now, real yields, moved significantly higher in the last year or so, and I think that the effects of that were largely offset by really good Chinese buying and really good central bank buying. I don't expect a huge change in real yields this year. In other words, I don't expect significant upside. I expect it to be somewhat rangy, so I think could play either way for gold. The things that might happen that might be kind of raise real yields is if you get the Chinese economy is going through quite notable deflation, and they're exporting their trade surplus is still very big. So if that sort of deflationary push kind of works its way into the general wider global economy, then that might, depending on how financial conditions are in the West, that might raise real interest rates a little bit, or real rates. It's kind of hard to say, but I mean that's if you're looking at the one single other thing that I look at, the real rates is the thing.
Okay, very important. And of course, we talk about all of these factors for gold in order to hopefully look at what the price is going to do in 2024. And I know you've got a couple of price targets that I thought we could go over, because I think that'll be interesting for
sure.
investors.
So obviously, looking at it technically, we look at a variety of different time frames, and I guess you should work sort of big frame back to a smaller frame. And the big frame, looking at where these targets come from is daily point and figure charts. So the two big standout targets in the upside for me in US dollar terms are 23.60 and 25.80. So given that, you can kind of you can have a target, but like there's no idea of when. Trying to put some kind of context on a possible when is I look at the options market and I try and see, okay, what are those strikes looking like in terms of the options delta? Because in reverse, that gives you an idea of what the market's pricing in terms of probability. So looked at that again yesterday just as a quick sanity check, and if I've remembered more or less correctly, because it was busy times, I think it was looking at it for the 9-month expiration, which takes us really takes us to December. I think for 2360, that target is roughly, I think it was like roughly, well, I don't want to get this wrong, like let's say 1 in 4 or thereabouts, right? And then for 1 year, it's higher. It's 1 in 3 or something. I'm trying to remember this kind of on the fly. So someone checking a price now might say, oh well, it's not quite there. So it's better than that. 2580 is obviously a much lower probability outcome, more like the 1 in 8. So that's a pretty low probability event, but it kind of gives you an idea of where the market is pricing in group terms, what those outcomes are. So then moving to a slightly smaller time frame, I've got a target 2182, which is obviously way, that's kind of in sight really at where levels we are now. It's $100 away, thereabouts. So for 6 months, that's like 42% probability. For 9 months, it's about 1 in 2. So that's not bad. That gives you some sense of where those targets are and just kind of how remote or not they are.
Okay, yeah, no, I appreciate the detail on how you came to those conclusions. That's very interesting. And I think I have to, no, not too detailed. No, I think it's just the right amount of detail. That was very good. I think maybe one thing, so we've gone through, what it's looking like for gold. Is there anything that can throw gold? I mean, you've talked about some of the headwinds for gold, but is there anything that can substantially really throw gold off of its, upward pathway? And yeah.
Look, I think
if dollars, in terms of headwinds, if the US dollar were to sort of really go on a tear, which I don't expect, but if it was to, obviously that's important. And I don't know whether this would be a 24 problem, but a lot of people do think it's a problem somewhere out there, 25, 26, whatever. The US government does have an enormous amount of debt issuance to get through. And that's not changing. That's not something that's going to go away, because neither party seems to have a really good grip on either the fiscal side or tax raising side or both. So U.S. government has to go to the market with a lot of treasury sales. If the market at some point thinks, we need a higher interest rate, a higher yield to incentivize us to buy those bonds, especially when you look at it in the context of the Fed entering sort of QT and kind of running off those bonds on their balance sheet. They've got to find other people to buy those bonds. If there was a change in psychology around that, and the market got much more kind of antsy about financing that deficit, and you saw a real sharp increase in yields, that would be a problem. The other thing that I think is a lurking issue is just how much kind of distressed debt there is, which we're all kind of aware of, the distressed debt in commercial real estate and so on. If that came to something that that's more likely, of course, to be a positive for gold as a sort of, flight to quality thing. In the short term, though, it might be quite disruptive because people actually drive for cash first. So you might actually see counterintuitively, gold might even drop in the first stages. It did that in the GFC because people ran for cash before anything else. And then once they reassessed, they were like, okay, more gold allocations.
Okay, and I asked that partially, I think it's good to look at both sides of the equation. And I ask it partially because I know that some people look at the gold market and they worry about manipulation in terms of the price. And I want to bring that up. One of my colleagues, for context for our audience, had told me you have a very concise way of explaining kind of what's going on there. So I won't make you go into too much detail. I don't want to spend too much time on this, but just your thoughts there briefly.
Yeah, sure. I mean, look, I know that for some of the listeners and so on, this is a really, really contentious topic. So what's going on? When funds and investors go to the futures market to buy gold, they have to find a seller. There's always a seller for every buyer. And depending on timing, there may be a variety of categories of seller, but usually it's going to be some kind of bank, some kind of trading house that stands by as a liquidity provider in that market. So the investor buys, could be a hedge fund or a CTA, they buy gold. Someone goes short against that. Now, if it's a bank that has to sort of manage their risk position, bank isn't just going to say, hey, we'll sell you millions of ounces of gold as you go in buying. They're hedging that as they go through it. Now, they might hedge some of it on futures. They might hedge some of it loco London. The point is they're going to end up with a balanced book. Crucially, outside observers can only see the future short. They can't see the inventory long, so they don't have visibility over both legs of that trade. They don't realize actually there's a long in the background that offsets the bank's risk to being short. So the question is why would a bank, why would a trading house do that? And the reality is that you're providing liquidity, but more importantly, as far as your the CTA remains long of gold and you remain short of gold, the futures curve for precious being in a contango, it's a rising curve. As you roll your positions forward, and of course the CTAs have to roll forward, they don't want to take physical delivery. It's not what they're mandated to do. They roll forward in from one active month to another. And as you're on the other side of that and you take that roll, you actually get paid like a sort of an extra total return for that. It's not necessarily big and it's not necessarily permanent, but that is if you like, the economic or the market incentive to have like a short futures position out there balanced against long inventory position. So there's like, there's always like a market incentive as to why things happen. That's the incentive there. But the crucial thing for people to understand is that short position in the futures market, you can see that. What you can't see is the fact that there's inventory or vault or local London on the other side. Because for sure, you know what? No one is going to be happy betting millions of ounces in an outright position against CTAs. That's not where that's where things are going to go wrong. So I hope that's concise and I hope it gives some insight.
Very good. That's exactly what I was hoping for. So thank you for going into that. I think we'll wrap it up here for now. Would love to have you back to have a longer conversation about what's going on because I feel like we just scratched the surface. But for today, thank you so much for coming by. I think this is a great introduction to yourself and what's going on with gold.
No, thanks, Charlotte. Really appreciate it.
Thank you. And once again, I'm Charlotte McLeod with investingnews.com, and this is Nick Frappell with ABC Refinery.